Bitcoin was once hyped as heading for $200,000. Now it's fallen below $90,000 because of worries about AI. Is this just a short-term stumble or a signal of a new era where AI is no longer seen as a money-printing machine by investors? In this video, we're going to break down why Bitcoin has dropped below $90,000. The crypto market is shaking because of concerns about AI profits. Why Oracle is standing right in the middle of that wave of panic, and what all of this is warning you about when it comes to your own money. First, let's go back to the shocking number. Bitcoin dropped below $90,000. Just a few weeks ago, analyst reports were still talking about the possibility of $200,000 by the end of 2025. Now, it's not just the price that's correcting. Even the expectations are being pulled back. The optimistic mood of Bitcoin can only go up has turned into an uncomfortable question. Have we been dreaming too beautifully about the future of AI and crypto? According to Reuters, this drop didn't come from some bad news inside the crypto world. It came from AI profits. Specifically, Oracle, a major US cloud company, gave profit and revenue guidance that was lower than expected. At the same time, it said it would have to spend heavily on AI infrastructure. That sent a warning to investors. The huge investments in AI are not turning into profits as quickly as Wall Street had imagined. Right after that, risk appetite in global markets cooled down. Tech stocks pulled back. Asian equities turned red. Futures in Europe and the US also pointed to a gloomy trading session, which had been seen as the darling of hot money, reacted even more weakly than the rest. Bitcoin fell about 2.5% to around $90,056. Ether, the second largest cryptocurrency, did even worse, losing more than 4%, dropping to about $3,196, wiping out the gains from the previous 2 days. Notably, this weakness stretched from the US session, right after the Federal Reserve cut interest rates. That move should have supported risk assets, including crypto. Tony Sycamore, an analyst at IG in Sydney, made a very blunt comment. Last night, even as other risk assets recovered, crypto almost sat out the move. In his view, the crypto market still hasn't proven that the October 10th sell-off truly flushed out all the weak-handed speculators. In other words, confidence is still fragile. And just one sneeze from the AI sector is enough to give Bitcoin a runny nose. But the story doesn't stop there. Standard Chartered, one of the banks that had been very bullish on Bitcoin, just cut its year-end 2025 price forecast from $200,000 to $100,000. That's basically cutting its expectations in half. The reason they gave is very clear. The wave of buying from companies using Bitcoin as a treasury asset has almost come to an end. The strong hands that pushed Bitcoin up during the peak phase are no longer net buyers. According to Jeff Kendrick, who heads digital assets research globally at the bank, the future path of Bitcoin's price from here will almost entirely depend on one leg: the inflows into ETFs. That means the structure of the market is changing. Instead of companies and institutions treating Bitcoin as digital gold to hold for the long term, the bullish story is now tied closely to how excited financial investors are about ETF products. So, what story do all these pieces put together tell us? First, AI is not just the engine pushing up tech stocks. It's also a thermometer for how much risk the market is willing to take. When people believe AI will generate huge profits, they're willing to pour money into all kinds of risky assets, from growth stocks and startups to crypto. But when giants like Oracle disappoint, that excitement cools immediately, and hypersensitive markets like Bitcoin are the first to react. Second, Bitcoin is entering a phase where it's being scrutinized much more closely. It went from being a symbol of financial freedom and a story of fighting the system to becoming a large financial asset. It's now tightly linked to the sentiment of funds, banks, and institutional investors. When smart money gets nervous about AI, Bitcoin is no longer seen as an alternative savior. It becomes part of a basket of risky assets that get trimmed when confidence is shaken. Third, the forecast being cut from $200,000 to $100,000 signals something important. The most beautiful stories about the future, from AI to crypto, still have to come back to real profits and real cash flows. No asset can keep rising forever just on belief alone. Behind every price jump are real people, real money, real balance sheets, and expectations that can shatter. So you, watching this video, and maybe having bought, sold, or at least thought about getting into Bitcoin, what should you take away from this? First, understand that today's Bitcoin price doesn't just reflect belief in the future of crypto, it also mirrors the market's faith in AI profits, in the health of big tech companies, in the Fed's monetary policy, and in overall risk appetite. If in the past, Bitcoin was told as a story completely separate from traditional finance, now it's moving in step with that world. Sometimes it's even more sensitive. Second, don't let price targets blind you. $200,000 or $100,000 are just scenarios on paper. What matters more is this: how much volatility can you really tolerate? Are you investing with spare money or borrowed money? Do you have a clear strategy, or are you just chasing the crowd? Third, watch ETF flows closely. Watch how the market reacts every time there's fresh AI news, and watch how those things connect to Bitcoin. Once you understand that connection, every spike and dip won't just be random shocks. They become signals that help you see the bigger picture. Also, remember that Bitcoin's history has never been a straight line up. Drops of 30 to 50% or even more have happened many times. They're often tied to different stories: policy tightening, exchanges collapsing, speculative bubbles, or simply tired money stepping aside. This time, the story is called AI and infrastructure profits. But the mechanism behind it is familiar. When confidence is tested, hot money is the first to leave. If you're a long-term investor, you might see these drops as opportunities. But an opportunity is only truly an opportunity if you know what you're doing, if you have a long enough time horizon, and if you're not being forced to sell at the bottom because of financial pressure. If you're a trader, what matters more is sometimes not predicting the exact top and bottom. It's risk management, setting clear stop losses, avoiding excessive leverage, and not letting a single position decide your entire financial future. One more point you need to think about. When everything from AI stocks and real estate to crypto is wrapped in stories about revolutionizing the world, it's very easy to forget that risk always comes with expected returns. If you're betting on the future of AI and Bitcoin at the same time, you're actually piling your risks into the same place. When confidence in AI wobbles, both sides of that bet can come under pressure at the same time. In the end, this drop below $90,000 might just be a correction in a longer journey, but it might also be a reminder that the era of AI as an endless money printer is entering a tougher testing phase. And every asset that lives off that story, including Bitcoin, will have to prove its value in more concrete ways. If you want to keep following analyses like this, where we don't just talk about price, but dive into the stories, the flows of money, and the psychology behind the numbers. Hit like, leave your comment, and subscribe to the channel so you don't miss the next videos.